Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money. In these episodes, we talk about the best strategies for making the most of your money. I'm Merryn Somerset Webb, and this week I want to talk about something that I think will affect an awful lot of our listeners, a major policy shift from the government around tax. Now, grieving families rather than pension providers are about to be responsible for calculating and paying inheritance tax on unused pension pots. And that's new, of course, the idea that you're going to pay inheritance tax on your unused pension pot when you die. So if you die now, after the age of 75, beneficiaries will probably also face income tax, and there is potential in here for you to end up paying a marginal tax rate of 67% on pension pots after the death of whoever held that pot in the first place. That sounds complicated? Maybe it is. To help us make sense of all this, I've got with me today Mark Wood, chairman of Everest Funeral Concierge. Mark is also the former CEO of Prudential and the current chair of PensionBee, so no one knows more about pensions than Mark. Mark, thank you for being with us today.
My pleasure.
Now, listen, I think I made that all sound more complicated than I needed to in the introduction. Just explain exactly what these huge changes are.
Well, I think we've got to go back a decade to George Osborne being Chancellor and the changes that he made in the 2014-2015 Budget and Finance Act, which really revolutionized the tax position of pensions and moved pensions from being something that, broadly speaking, either you pay inheritance tax on your defined contribution pension pot or you lose all the money from your defined benefit pot. So what he did was to remove this concept of compulsory annuitization at the age of 75 so that people could have an asset in terms of the money that had accumulated for their pensions that they could then transfer on to their beneficiaries without inheritance tax. It became an anomaly within the assets that somebody has when they eventually die. The Rachel Reeves change reverses all of that and, as you say, puts the onus on those people left behind, the grieving families, at a time when really nobody's equipped to think about the complexities of probate and all of the dreadful administration that comes particularly with unexpected death and these changes hit hardest for those that die before the age of 75, which these days is dying young.
That's true. Mark, can I just take you back a little bit to how it was before? So there was a stage, pre-Osborne, as you say, whereas you had your pension pot built up and your defined contribution pot, your SIP, whatever it was. And then when you came to retirement age, the only way you could draw that money, unless you could fulfill there was quite a strict group of conditions that meant that you could do it differently. But in the main, you had to take that large pile of money and pay for an annuity, which gave you a regular stream of income forever. And the annuity market was a mess. Older people might remember that. It was a mess. It was exploitation and conflict of interest and all sorts of things, wasn't it? And so when George Osborne did this, it was an absolute revolution for pensions. And it effectively made the pension pot into a family trust.
Yeah.
Because you could pass it down generationally without paying any inheritance tax at all. And you could hold it inside the trust and simply draw income from it as and when. So if you had a low income, you could draw money from it and then you would be paying either no or a very low level of income tax on it. If you had a higher rate of income tax, maybe you'd hold off on drawing money from it. So it effectively, after all these years of clamping down on trusts and ways for people to avoid taxation via the trust system, this produced a whole new system for allowing people to pass large amounts of money down through the generations, right? And we kept looking at it and saying, that's nuts. At some point, someone's going to go, whoa, hang on a tick here. That's got to be liable for inheritance tax. And here we are, right?
And it was even more dramatic than that because the focus previously had been on age 75. What happened under this change was that from the age of 55, you could start drawing on your pension. So you could carry on working. You had accumulated your pension pot. You could then begin to take money out of your pension pot and maybe pass it to the next generation, taking advantage of what was the 7-year rule for inheritance tax. So it gave huge personal financial flexibility over what is, for the vast majority of people, their largest or their second, with the family home, their largest or their second largest asset.
And this then created the incentive for people to pour as much money into pensions as possible.
Correct.
And when we were giving people ideas about how to manage their money, we would say to them, do you know what? Spend everything else first. Spend the ISA, spend everything you have outside of it, and protect that pension at all costs, because that is going to your heirs IHT free. Hooray.
Yeah. And of course, we had the growth of the equity release market as a consequence, with people taking money out of their residential property and, as you say, keeping the pension pot protected. They drew money from elsewhere.
Yeah. And now what we're seeing, is I've just been looking at some charts, is we are seeing exactly the opposite. We are seeing a rush to get money as quickly as you can out of pensions. So the number of people drawing the amount of money that you're allowed to take out of your pension tax-free, which used to be 25% of your pot you could take out tax-free when you hit retirement age. And now it's a maximum of £268,275 is the maximum you can take out now. Unless, by the way, and you will know more about this than I do, Mark, unless you have one of the many, many fixed protections for our rich older people who always seem to have some kind of protection or the other. And if you have, there's one particularly good protection. If you have it, you can take out over £600,000 tax-free. Well done, those of you who have that exemption. We don't really like you, but, there it is.
There's another wrinkle that's coming here, which is the looming threat that tax-free withdrawal that you've just been talking about also gets taken away.
Which is why everyone is rushing to do it now. And if you look at the charts of this amount of money being withdrawn, you can see this exponential rise over the last 18 months or so of people just going, do you know what? I want it out of that wrapper and in my control. I'm no longer interested in the tax benefits of holding money inside a pension. I just want it under my control. Although, of course, they'll be sorry if it turns out one of the things introduced in the next budget is a wealth tax that excludes pensions. It's another conversation.
Indeed. But I think also we've just got to touch on, I mean, you were taking people back to a previous period. And of course, in the previous period, many, many, many people relied on their occupational pension schemes, their so-called defined benefit pension schemes. And another of the consequences of the Osborne budget pension changes is that people took what were described as enhanced transfer values, taking money out of their occupational pension scheme and putting it into a SIP. And of course, the logic for doing that was that the defined benefit pension plan is a little bit like the annuity that you were previously forced to purchase. It expired with you. Whereas if you held the money in the defined contribution pot, that was an asset, as you say, that you can then take and use with your family can inherit, etc., etc. All of that now changes. So all of the considerations around the tax planning that people have been so careful about over the last decade now needs completely rewriting.
Yeah. So this comes in. So let's talk about what is planned now by Rachel Reeves, who may or may not still be in post when these changes come in, which is at the moment mooted to be April 2027, right?
Yep.
And so from that date, if you die older than 75, it's different for under 75, isn't it? So we'll come back to that. Over 75, that pension pot is then liable for inheritance tax. And then once you start to draw from that pension pot, the money that you draw out as the heir will also be liable for income tax. So when we talk about a possible rate of 67%, we're talking about 40% inheritance tax paid first, followed by paying the higher rate of income tax. Is that right?
Correct.
Okay. Doesn't seem to be much you can do about that.
I guess it's kind of the reverse of what you were just describing, rather than leave all the money in the pension pot. Maybe we're going to see advisors now talking about taking all the money out of the pension pot. But the difficulty is, how do you create a tax-free income stream from the pot that somebody's bequeathed over the age of 75? So I guess, SIPs would be, ISAs rather, would be an option where you could build up an amount, but there are caps to the amount that you can put in. For most pension pots of any size, that would be insufficient. But looking at a way to shelter that money otherwise is tricky. Some advisors are talking about putting insurance in place to cover the inheritance tax obligations of shifting the pot early. So now have to look at a 10-year runway in terms of making gifts to beneficiaries. But that element of inheritance tax planning, how do you give money away so that it doesn't get into probate and doesn't become an asset, and the family don't have to worry about the inheritance tax. That's gaining huge traction with financial advisors, and pretty much every annual review now is having to take account of age, wealth, beneficiaries, and the current arrangements that are put in place by the will and how that is modifying.
Yeah, I mean, the obvious immediate thing to do is to take that 25% up to the highest amount that you can.
Correct.
And to give it straight to your kids,
Yeah.
assuming you can afford to do that.
Yeah, it's such an unusual benefit. It's politically very difficult to do. I mean, along with the triple lock, it's been a statement of faith for governments for a long period of time. But it is an anomaly in the tax regime in that you get tax relief on the way in, and for this amount of money, you get tax relief on the way out.
Whereas ISAs, of course, are the opposite. You get no tax relief on the way in, but you get it all on the way out. And that makes sense. And when we look at pensions, we think of it as being tax relief on the way in and nothing on the way out. But of course, there is hidden away this 25% or £268,275, which is tax relief on the way in and the way out.
Yeah.
Of course, that's the great incentive of pensions. Without that and without IH2 relief, it's hard to see how anyone would be incentivized to save anything beyond the minimum of their auto-enrollment contributions into a pension.
Yes, I mean, I think we've seen quite a lot of research recently. I think we at PensionBee just published some research showing just how small people's pension pots are. So there's a delicate balance there. There is a trap, of course, that people have got to be aware of with the tax-free sum. The current rules allow you to take the tax-free sum from the age of 55. So it's quite tempting, if you're 56, 57, 58, and you see this looming change, it's quite tempting to take that money out straight away. But if you do that from a tax point of view, you have retired, and therefore you can't put any further money into the basket that you'll get tax relief on as the money goes in. So it requires a careful calculation. You need to be confident that the residual pot is sufficient for what your requirements are likely to be when you eventually cease earning.
Right. Okay. Good point. Good trap information. Can I just ask you to explain what's different when you're under 75?
I'm not sure I know.
Well, I'll tell you what I think it is. I think under 75, I think it would still be liable for IHT, but it is not liable for income tax. Because under the old rules, if you died before 75, that pension could then simply break and you would receive the entire amount tax-free, or you could withdraw from it tax-free, which is really fairly extraordinary. I mean, that really is no tax on the way in, no tax on the way out. Whereas if you were over 75 previously, you did have to pay the income tax on it. So that's the difference. Sorry,
I thought you said under 25.
I did wonder why you didn't know the answer to that one. Yeah. Fascinating. Did I get that right then?
Yeah.
Okay, good. Okay, and then the other thing that I wanted to ask a little more detail on is this idea of taking out insurance. How does that work?
So the tricky decision is knowing when you're going to die. So death is certain, but the date of your death is not certain. And so looking forward and planning, the cash flows are required to keep you in whatever style of life you want to be kept in for your life. How much of the pot is then left over? And how much can you afford to gift away? So there are a bunch of different thresholds for gifts. If you've got a child or a grandchild getting married, you get the £5,000 allowance for a wedding gift. On the birth of a child or grandchild, there's a £3,000 allowance. There's the annual occasional gifts of £250. So a whole labyrinth, and there's a very good government website that covers all that stuff. But the big one is, how do you make gifts that will not impact your lifestyle? Very important to write a letter to the beneficiary saying, dear beneficiary, I'm giving you £5,000. Please rest assured this is going to have no impact on my standard of living, because that's the tax trigger.
Yes.
So you make that clarification in the letter that accompanies the check or the bank transfer. But then once that money has gone across, you've got to survive for a period of time. So there's a graduated declining tax liability, currently over 7 years, soon to be over 10 years, where there's residual tax. So in order to avoid, so let's imagine that somebody pays off their mortgage, or they pay school fees, or they buy a car, or whatever, some capital amount. They then don't have the cash to pay the tax that would happen if the person giving the money dies in 3 years or 4 years. So the prudent thing that many financial advisors would suggest to the person giving the gift is to take it a declining value of insurance out over the residual period, so that when in the unlikely event that something horrible happens and you've got the tax liability crystallized, the insurance policy pays it rather than you having to find the cash.
Okay, so basically you're taking out insurance on money that you have handed over early. There isn't really a way to take out insurance if you haven't gifted money. That would make no sense.
That's right.
Okay. And can I just take you back to gifts out of income?
Yeah.
I thought that there was not a tax liability on regular gifts out of income that did not affect your standard of living.
No, there isn't.
There isn't. Okay.
Yeah.
Just wanted to clarify that.
I mean, the reason I make the point about the clarification is that if you're making a gift of some substance and your estate is opened up, it's very helpful for the person that's received the money to have that.
To have the letter. Yeah. But those gifts have to be regular, don't they? Isn't that the idea? You can't just give a lump sum and call it a gift out of income.
The classic way in which so let's imagine that somebody's got 5 grandchildren and they're helping with the school fees. That's going to amount to quite a big amount of money.
Yes.
For that individual, but it can be affordable and it can be regular. But it's worth just jotting down in a note, I'm paying this, but it's not having an impact.
Okay, understood. Thank you. Okay, now let's say that I'm looking at all this, and I'm looking at Rachel Reeves, and I'm looking at Keir Starmer, and I'm thinking to myself, gosh, maybe he would go, maybe she would go, maybe there might be something even more left wing put in place, maybe my taxes are going to go up more and more and more, and I'm kind of over this whole thing. So I am going to move to Milan with all the other rich people, and I'm going to go there and carry on with the bidding up of house prices so the local people can't afford to buy. The usual dynamic, right? The usual dynamic. Someone puts in place something to attract rich people come, they price out ordinary people, and then 10 years later they reverse the rules on the rich people. But here we are. We're going to Milan where the rules are still in place. I only have to pay, I think it's $200,000, is it, or 200,000 euros, 200,000 euros a year, flat rate, however high my income. So I'm all over that. I head to Milan, I buy myself a nice penthouse flat, maybe a nice townhouse. I don't know. I think I'd prefer a townhouse personally, but you may prefer a flat. How long do I have to worry that they're still going to come after my pension?
Well, quite a long time, I think is the answer. We do, of course, have the reverse situation, which is that Nigel Farage gets into power, and as he announced a couple of days ago, alleviates the whole burden of inheritance tax, which means that you've paid for your international removal firm and you bought your Ferrari out of mistakenly, because actually it makes a lot more sense now to be paying 5% on assets over £3 million or whatever it is. And suddenly your farm may be tax-free rather than taxed without business rollover relief at in excess of £1 million. So it's the planning right now in this period of incredible turbulence politically, I think is incredibly difficult. And of course, the upheaval of, there are people clearly who are mobile internationally, and London has been a relatively safe, and maybe people's judgment of that's changing after the weekend, a relatively safe place to live. Traditionally, we've been regarded as having a relatively stable government. Again, that view may be changing. So there are mobile people who will move, as you suggest. Dubai has a particularly attractive offer on at the moment, I think, as well. And of course, you can go to Spain, as many people have for many years, and agree a cap on your liabilities.
Okay, well, let's say I head off to Spain or Italy or whatever, and before I go, I give each of these grandchildren of mine not a gift out of income, but a lump sum of £250,000 each, and then I'm off. They're on their own. I've given them the money. We're all done here. A mere 6 months later, while gloating about something or the other, I have a heart attack. I'm off. I'm gone. Will those heirs be hit with inheritance tax?
Correct. Yeah. And
they will.
And the whole process of probate, and as you said right at the beginning of this conversation, the the obligation to pay the tax falls on the beneficiaries, and their accounting for those receipts will be as if the move never took place. So the excess reoffer that's caused the cardiac arrest will create a new burden on people that thought that life was relatively simple.
Okay. All right. So here we are. I think we've been through all of it. So let me ask you one last question, Mark. Have you taken your lump-free sum?
Oh, definitely. Long ago.
Long ago?
I took my tax-free lump sum on my 55th birthday at the maximum amount.
Interesting. But what do you do with it then? Because then you take it out of the investment portfolio that it's in. Suddenly you've got money that is now subject to income tax and capital gains tax, which might require, this is probably a longer podcast, but possibly requires a slightly different type of portfolio to one where everything accrues tax-free, right?
Yeah. I mean, it depends entirely on an individual's asset mix and the opportunities that an individual has got to... In my case, I was setting up a new business, opening up a new insurance company. So it was an obvious thing to create an amount of capital that was available. But everybody's circumstances are different, particularly as they reach that stage in their careers.
All right. Brilliant. Mark, thank you. I strongly suspect this is a topic we are going to come back to again and again and again. But thank you for explaining it also clearly. We appreciate it.
But if I've passed the test, do feel free to come back to me.
Thank you. Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi and Moses Andam. Production support and sound design by Blake Mabels and Kelly Gary. Questions and comments on this show and all our shows always welcome. Our show email is merrynmoney@bloomberg.net.